Good evening, friends. Welcome you to today's webinar. Today, our discussion is on the factors that are impacting the performance of commodity markets, particularly with respect to gold. And we are also going to have a comparison between gold ETF and the equity ETFs. We have already seen equity ETFs in detail. We have also seen the debt markets. So let's see how the gold ETF performs on one-time investment basis or through SIP. So some of this probably will highlight that how you should approach towards gold investment. And also we will also look at factors which are affecting the commodity prices. The last few months we have seen huge volatility in commodity prices. Something probably it has moved in tandem with the equity markets. Equity markets moved higher and commodity markets also have moved higher. The bottom of both the commodities as well as in the equities coincided with last year, the pandemic breakout, that was in the period of March, April. Ever since, every other commodity or asset prices have almost doubled from its bottom. For example, Nifty was at 7,500, this 15,000. So similarly, if you look at the performance of copper also, I think it has almost rallied very significantly. Crude even plunged below zero, now it's around $60 plus. So most of the commodities have recovered in a very significant manner. So it is not something which is only for gold. In fact, gold has been taking an opposite direction for the last couple of months, even when compared to other commodities. When other commodities are moving higher, gold is on a declining path. So we will see the reasons as to why gold is behaving like this, and how we should approach towards gold, as well as probably we'll also look at the other commodities also. Now, gold is generally, it's not an industrial metal, it is an investment plus ornament. This is the general purpose. As investment purposes it is used, then it's used for ornaments. It has got very little application in industrial thing, unlike silver, which has got some amount of application, particularly in semiconductor, electronic manufacturing, all those. Silver has got some application as far as industrial metal is concerned. So gold is purely an investment as well as the ornaments. And gold, for a very long period of time, was considered as a safe haven thing. That is, because it is a commodity which has been that time immemorial, right? And it was always considered as a currency. Now, other currencies came later, and every other currencies had some life. That is, when this currency was launched and all those things. But gold has been a commodity which has been used since ancient period. So gold has its own charm, and gold is always considered as a very safe investment, mainly because it gives the liquidity. First of all, the reason why it was preferred for a very long time, and even now in India and everywhere, is liquidity. You buy something, you go to the shop, you give it, and immediately you get plus or minus something is always there, but you have got a good amount of liquidity. Suppose if you invest in real estate, even if the price goes up, you cannot just like that sell, right? So it will take time. And second thing is that in real estate you have to put in a lot of money. One time you have to put 50 lakhs, 1 crore like that. But whereas in the case of gold, you can buy even 1 gram. So you can keep on investing smaller amounts also. So gold has its own charm, and because of its liquidity. And second thing is, normally when problems arise worldwide, gold is the first commodity which is preferred, because it's considered as a safe haven. Because other currencies or other assets, there is always a confusion how these assets will perform in light of the changes that are taking place globally. So gold is a commodity which first gets its preference. And second thing is, gold is very closely linked to, globally it is linked to inflation and interest rates. Because the reason I am saying this is because it's an investment metal. It's an investment metal, right? So when you look at the investment return, what does it mean? If the interest rates go up, you will generally prefer to be with a safer deposits rather than gold as far as investment is concerned. And that's the reason why in a higher interest rate scenario, in a market where interest rates are increasing, gold generally will not perform that well. That is what we are now seeing. Now, gold generally goes up when global interest rates go down substantially. Global yields decline. Generally, this is the relationship between gold and global yield. And the global yield is generally yield. When I'm saying global yield, it's an interest rate. So let us say USD, 2 years, 3 years, 10 years, government of India, like government of India securities, as the US treasuries. And the yield in these 2 years, 3 years, 5 years and 10 years. Okay. And gold is also a very leading indicator. If you see gold performance, gold normally leads other markets. Now, when I say leads other markets, in the sense, the direction of other markets, in the sense, gold can be a leader to reflect where other currencies, even Euro USD, will move. Where probably even Euro USD will move. Okay. And gold also will give an indication that about the yield. Now, if you see the gold in the last couple of months, if you see the chart, it is coming down for the last 5-6 months. In fact, the last 6 months it has not done well. So, ever since July-August period onwards, if you see the relationship between gold and US yield, 10-year yield is going up in the last 6 months. It accelerated recently, but it has been generally it bottomed out. Yields bottomed out in June, July itself last year, and ever since it has started rising. Now, that coincided with the gold top also. So, gold started to give a flash and indication that probably the yields are likely to jump higher. So, are likely to jump higher. And at some stage, we will see even other currencies like euro, dollar, which has got a very good correlationship with gold, will start moving like gold. For example, if the gold falls, euro dollar will fall, but there is always a lagging period between gold and euro dollar. Okay, so what does it mean? That because the gold is more closely linked to the inversely linked to the global yield, if the yield start rising, then gold will fall. And last even yesterday, when the gold fell now below $1,700, the yield went up. Now, one of the reasons why equity markets in the last couple of days is quite volatile, and today it was down. And globally also we see a lot of equity indices now slightly on the defensive, is because of the rising global yield phenomenon. Now, why does it happen? Now, if you see, because of the pandemic situation, globally central banks are flooded the system with liquidity. There's great amount of liquidity right now. Now, this liquidity initially props up the asset market. So, this helps all asset markets. This helps all asset markets to go up. And that's the reason why we saw gold initially rising quite rapidly even when compared to others. So the first amount of liquidity just flows into gold and equity indices, broad indices. And we saw the first major gainer was gold, and almost till June, July, gold was doing extremely well, both in dollar terms as well as in rupee terms. Now, if they plump in with that much of amount of liquidity plus extreme amount of stimulus, okay, then that means this amount of liquidity always creates a fear of inflation, because you have got too much of money available in the system, it creates an inflationary impact. Okay, now because it creates an inflation, okay, now yield starts moving up. So because of the liquidity, instead of pushing the interest rates down, that much of interest rates pushing down, it creates as a counterproductive measure, it triggers inflation, because asset prices keep going up, right? The liquidity pushes up the asset prices, and because the asset prices go up, the inflation goes up, and the consequences for managing the inflation is only met with higher interest rate. Like in India also, if you see the interest rates, last couple of months it's maintained at around the same levels, mainly because the inflation is still high. The inflation is high. It is mainly in India, it is more due to agricultural products and because of supply chain problems. So they have to see through as to which is creating that inflation. If there is a very temporary effect of some supply problems or monsoon problems, now those things probably may be tolerated, because that will have a fading effect. But if the liquidity is creating too much of price pressure, then in that case, the banks will be forced to, the central banks of the world will be forced to act to tame inflation, because inflation is a big tax on the poor, because the inflation affects everyone. If the price goes up, now we have seen in India also, a couple of till before the pandemic, if you look at the real estate prices, it was just going up and up. So it was getting out of bounds of a common man. Similarly, a lot of agricultural prices, like vegetable prices, all these things keep moving up, and the fuel prices keep moving up. So, if the inflation is not tamed or it's not kept under control, it becomes like a tax on the poor, because the rich can always pay for that. So what happens is the poor people get affected more because of the inflationary impact. So governments worldwide and central banks worldwide will try to ensure that the inflation is maintained, because nil inflation is literally impossible, except in some countries. But a country like India, it is not possible to bring the inflation below certain levels. But a decent, stable inflation, a little much under control, so that everyone is kept a little happy, both the supplier and the consumer. I think that is what is aimed at, not a zero inflation or not a very high inflation. So it is maintained. In India, it is, they look at something like a 4% inflation target with plus or minus 2% band. But generally, they would prefer to keep it between 3 and 4% is what probably the government also aims, and the Reserve Bank of India also aims. Similarly, in US also and Europe also, they have a control, they have a clear benchmark towards to what extent the inflation can be there. And above that level, they are forced to act in order to ensure that the consumers don't suffer or the general public doesn't suffer. So one of the instruments in order to ensure that asset prices don't go up, in order to cool down the asset prices, is the monetary measure of increasing the interest rate. Now, once you increase the interest rates, what happens is the fixed deposit rates. Globally, the rates are so poor and bad. But in India, suppose let us say, just for example, today let us say you get an interest rate of 6%, maybe 5%. In some banks they give 6%. Let us say this 6% becomes 8%. 6 becomes 8%. Then the amount of rally then you will expect in equity markets or in gold should be much higher, because you need a risk premium, right? So you cannot have an 8% FD deposit and the equity index just growing by 10%, because then in that case the gap will be 2%. So you'll think that whether it's worth taking the risk. The risk premium has to be substantial. In US and all, the risk premium is something like 10 to 12%. When I say that, it is like this. That is, the interest rate is 0 to 1%, let us say, the depositor. But equity market gives a return of something like 12% plus. So this gives a premium of something like 10 to 12%. 10 to 12%. In India, if you have an interest rate, risk-free interest rate of anything between 5 to 6%, then the equity markets will have to get around 17 or at least 15% per year. If this is not achieved over a period of time, let us say over a period of 3 years, maybe 1 year and all, it will be a little difficult to say, but you should have something like this. So if you have to get over a period of 3 years and 5 years, something like a 15% return per annum, then only you have that substantial gap, you can say, with this one. Suppose if the interest rates become 8% and equity market return 10%, I think generally it will not be preferred. It will not be preferred, right? So that is what is happening now in the markets there. The rising amount of yield. What is happening is there could be one reason is what I told you. The second thing is already those who have invested, probably they are making loss now in treasury papers there. So when they make a loss in one asset price, then normally you liquidate some other asset in order to compensate for that. That's a very normal behavior, right? So if you make a loss somewhere, wherever there is a profit, you try to take profit in that so that you are able to adjust your book. That is also one of the reasons that the losses being made in the interest rate side is being compensated by selling those which have been profitable over a period of time, and gold is one commodity which is which is hit because of that. Now, if you look at it, the same amount of liquidity which came in because of the economic recovery that is taking place worldwide. In India also, the good pace of manufacturing and service expansion is taking place. Globally also, manufacturing is doing well, whether it's US or Europe, all those places. And because of that, the demand for industrial metals have gone up significantly. Okay, whether it should have resulted in this much of a price rise, that could be questionable. But if you look at the chart for copper now, copper is one which went up very significantly, right, in industrial metal. Even silver, for that matter, rallied very significantly in the last couple of weeks and months. Silver. Now, crude is again because of the demand that goes up for the crude, because of energy requirements going up. So all these things have translated into very high prices, resulting in, even in auto companies, they import copper, aluminium and all. So it results in a cost push for them. So you just see these prices going up. Now, because if these prices go up, copper, steel and other prices go up, immediately you get the benefit is translated to commodity companies. That is why we saw commodity stocks till now doing very well, like Tata Steel, Vedanta, JSW Steel, type of companies did extremely well in the last Hindalco, Grasim. All these companies have done extremely well in the last couple of months and weeks, mainly because of the surge in the commodity prices. If the commodity prices is to take a reverse, I think these stocks also will get brutally hit. And if there's enough amount of weightage in the index, probably it can have some issue as far as the index also is concerned. So now, to the copper and other things, because of the because of the demand for the industrial metals going up, these things rallied. But because these prices are going up significantly, it has an impact on the inflation. Gold has started to come down. Normally, gold is considered as an edge against inflation. Okay, generally as an edge against inflation. So if the inflation goes up, then they think that gold should be in a position to compensate for it. It will happen, but it will happen with a lag after some time. Initial reaction is, if the interest rates are tightened, then normally whichever currency the interest rates are tightened more, that currency will get a benefit. For example, if US economic performance is good and US is the first country to tighten the interest rates, then we will see the dollar rally up. The dollar has got a great correlation with gold, because the entire world trade, particularly in gold also, it is more closely linked to dollar. So the moment the dollar climbs up, then in that case the gold climbs up. But the question is, which one leads the other? Now if you see gold, I feel gold leads the other. So gold gives the first sign of whatever that is likely to happen worldwide. So now the first sign that is coming as far as the gold is concerned is that interest rates are likely to get tightened over a period of time. And because of that, we should see asset prices having problems. And the first thing that has come is the form of gold, because if you look at it, gold also led the rally before the equity markets. So that is important thing that we have to note. Gold was rallying even before the equity market started to rally. Equity markets had a mainly because of the pandemic, and after that it started to climb. But gold was rallying very significantly during all those periods, and that showed that the other equity indexes also will follow suit, and so the rally in gold was a precursor to the rally in the equity markets. Now the gold has stopped out. Okay, gold has stopped out and gold has started to fall. Now will this lead to probably a correction, if not a big fall? Whether it will lead to a correction in equity markets is something which we need to watch out very clearly, because till now the gold has been a leading indicator for any other asset and commodity prices. Initially the commodity prices were behind the rally in gold, and it caught up. Now the gold has started to fall along with the rise in US yields. Will it significantly give a reversal as far as commodity prices is concerned and as far as equity markets is concerned? So is gold sending a message? Is something which we need to note for a period of time. So what it means for investors like us who want to invest in gold. So you get a feeling that, okay, now gold is likely to fall, and so let's wait for some time. That's the thing that probably you'll have a look at it. So the asset markets always take you by surprise. And our problem is, once gold bottoms out and from the bottom it starts to rally, then we will always think that no, I saw some price yesterday. Now today it is 5% more than that particular price. So let it fall, I will invest or I will not invest because it has gone up by 3 to 5% from the bottom I have seen. That is the mistake that we do because we cannot catch the bottom. Now let us say the price has fallen from 2000 to 1700. There is no harm in trying to catch the gold at around $1800 if it starts to, if you know that 1700 is a bottom and from 1800 is going to go to 2100. So you cannot then wait and say I saw 1700 a week back, so I will do. So once the trend looks like changing based on the fundamental scenario that emerges at any point of time, we should be in a position to prepare ourselves to catch that particular thing, right? So let us look at gold as a chart and see what we should do as an investor. At the same time, we will see how the ETF of gold has performed over a period of time, so that you will know whether at what point of time of investment in gold is very important, or whether an SIP type of investment in gold is also productive. Because we have seen in equity markets, SIP return is higher than the one-time return in most of the time, whether it's 1 year, 2 years, 3 years, 5 years, whether it is in ETFs, index ETFs, or whether it is in large cap stocks also. Because you get some fall at some stage, so which will help you to average out. Okay, so you get definitely a better return in SIP over a period of time. Does gold also fit into that category? Let us see the data and statistics and arrive at some conclusion. Of course, the past history is not going to be a complete indication, but we will get some idea. So before we proceed to that, let us look at the chart of gold. I am only projecting now the gold dollar price, not coming to the Indian price right now. So what we have seen now is that gold, a very significant rally closer to 2100, and now has started to look towards some correction, right? So where do we get this correction now? Now let us look at whether we're going to get something like a this high was say 2073. Now 2073, normally any big fall generally you should have 20 to 25% of correction and then it should start to rise. So a 2073 into 0.8, it should come close to 1660 levels. So 1650 to 1660 levels will give 20% fall. So this should be somewhere here. So a little more fall probably in gold, and then we could see some sort of stability as far as gold is concerned, or probably it can fall up to this height, which is 15,557. So we can expect something like in 1650 to 1550 as far as gold is concerned. And we will also look at the on the technical side. Let's look at the Fibonacci ratio. We will put from this particular level. So we are getting something like 1620 to 1510. I think this is the place where we have to just see whether the gold bottoms out. 1620 to 1510. We'll just remove this for the time being and put it from this level also. So it is at 1681, 38.2, and then 50% is 1560. So very likely chance that probably gold, which is may have a support close to 1680, and a failure below 1680 could probably take it down to 1559 or 1560. Now, any particular rally now will meet a strong resistance towards 1830 levels, because that was an important support level of 23.5% retracement. So we should see, since that market has fallen below that, 1825, 1830 is likely to be a major resistance. And only a break above 1830, probably we can say the market is going to resume its bull trend. So right now, let us expect 1680 to 1833 being the first level, or probably then it will come down to 1560, and if it comes to 1560, then it will trade between 1680 and 1560, and then it may break the 1680 to go up. So the places where probably we can look towards investment is gold is on the technicals basis. Gold has a strong support close to 1680 and then 1560, and this is a 2001, and so 2073 minus 1560, that is 513 divided by 2073. It marks 25% fall, and probably yes, this could be a very, very important level. So a 1560 is a possibility. So 1680 and 1560 is a possibility, and so we should expect a lot of support to come closer to the 1560, which means another 7-8% of fall is possible as far as gold is concerned. Okay, at which time it can become very attractive for investment. Now we go back to the chart. I see that where the previously what happened. So here it was this place, 1920 to 1666. 1920 to 1666. So that was translated into that was a 13% fall. So now this was a 13% fall, but after that it fell down to around 1100, which was a greater fall that took place. So I think probably we don't need to look at this because it has already fallen. I think by 12-13% fall has already taken place as around $250-$260, and that was the 1830 level. So I think that scenario is over. So the first thing that happens is in case of gold, I think the 12.5-13% fall is what happens, and after that, if it is going to go down, then there is a very substantial amount of fall that takes place. So we could probably now expect that 1680 if it's broken, then 1550 or 1560 to come. Now, once that particular place comes, then we are 25% below the top. So we have seen that over a period of time, some important tops are being scaled. But let us look at why we should wait for a dip to buy. So here in this particular case, it was in the period of 2011. So 2011, till 2000, because 2009 coincided with the Lehman collapse, series of rate cuts, liquidity pumping, everything took place for some time. So 2010-2011 period. Now from 2011, generally the interest rates peaked out. Okay. I would say bottomed out, and then it started to slowly rise till it was raised in 2017-18 period, which also coincided with this. So this being a leading indicator. So now what happens is the interest rates were increased only subsequently, but gold started to move down, and if you see the performance, it came for 4 years. In fact, gold was down from 2011 to 2015. For 4 years, gold was down. And even for a long time, if you look at it in dollar terms, I think even now on dollar terms, I think right now it's 2021 and this is 2011. So in dollar terms, I think gold has had no return. If you look at the 10 years performance, which normally should not be, because if you look at the equity market, some in between fall will be there, but any point of time you consider a 10-year history, we should have something which is on the positive side, right? Unfortunately, gold 10 years later is now still not in dollar terms, it is not given any value. Maybe in terms of dollar rupee value, because of its own reasons, we might have got some return as far as gold is concerned, basically on the dollar rupee factor. So this clearly shows that gold is something which you have to be very careful. Thinking that over a period of 10 years it will give you all those things. It will give, but you have to decide about when to make an investment. When to make an investment is going to be very crucial as far as gold is concerned, because if you have done just one 10-year block before that in dollar terms, you would not have got a return, right? But if you have invested somewhere in 2015, you would have got a fantastic return. So you need to be very careful about picking up this investment. But since the fall is taking place here, probably if you have done some SIP type of scheme over a period of say 10 years or so, there will be some return, because for a period of 10 years you would have been somewhere in the average of this period, right? So you will have a return. So over a 10-year period you would have just got not much of a return as far as the dollar position is concerned, but the average thing should have given you something. So let us look at what has been the return in gold in absolute values on annualized basis for a period of 1, 2, 3, 5 and 10 years period. So we will use the moneycontrol.com for this historic returns in index fund. So this is Nippon India ETF Gold Bees. So okay, Nippon India ETF Gold Bees, and let's look at the returns that is there. I will read it out for you. This is a white background, so I'm not able to, probably may not be able to see this. 1 week the return is 3.5% down. 1 month it is down 5.5%. 3 months 9.5%. 6 months is 13.5%. Since this year beginning it is 10% down. So the last 6 months, that's what I'm saying. The last 6 months or so it has not done well, and even a period of 1 year, if you look at it, it's just 1.37%, even in rupee terms. So if you say 1.37% over it, that means you compare with last March with this March. Okay, gold has not performed as far as the dollar rupee, because in the case of a dollar position, it might have given some return. Because rupee appreciated by 5-6% from that level, probably will not be giving this return. Now let's go back. If you look at the dollar last March, see, this was 2020, if you look at it. Okay, this was okay, this was the second month. This is the fourth month. So we will look at this 1 month before. This is the February end. So February end last time was 1565. Okay, 1565. Now it is 1696. Okay, so 1565 to 1696, $130. Approximately $130 by 1565. It's around 8.3%. That time the rupee was 76 or 77. Now it is 72. So the 5 rupees, their fall is around 6 to 7% there. So the 8 minus 6 gone. So it's just 2% or 1% has been the return. So that is the reason why you are seeing, because of the rupee impact, we are now seeing the gold performance slipping to just 1.37%. Now if you look at the 2 years, it has given annual return of 15.42%. So exactly the same period of March to March they are comparing. A 3-year basis has given 12.75%. Okay, return. These two things are acceptable in the sense that acceptable when compared to equity markets also, because equity markets performance also a bit of 2 years and 3 years, you would have got the same return. But if you look at a 5-year performance, 6.89, you look at a 10-year performance, which gives you more of a clarity regarding where the dollar, because the 6.79% 10-year, if you look at it, it has come mainly because of dollar rupee. Because if you in terms of the gold performance over a period of 10 years, exactly if you take a 10-year previous period, let us say, where do we have that? So let's look at 2011 March period. Okay, it was 1432. It was 1432, or February end was 1411. So it was the 1420, 1430. Now it's 1650 or so. Okay, right. So 1680. So 250 divided by 1430. It has given 17.5% absolute value. Just translated into around 2%, 1.75 to 2%. So the extra thing in the 10 years of 4.5, 4.6% has come predominantly from this one, that is dollar rupee. So it is the dollar rupee which has given the performance as far as gold is concerned, okay, and not the spot dollar has given that return. So it is not the gold performance per se. So very clearly it's a show done by dollar rupee which has given you the performance as far as gold is concerned. Because if you look at the performance in dollar terms, it is hardly 1.7 to 2%. That is the reason why the rising yields is having the impact. Now you understand. The 3 years and 5 years for a 10-year period, gold has performed only to the extent of 1.82% and all. For a period of last 2-3 years, of course, it performed well. But 1 to 10 years longer period of time, gold has not performed. Gold has not performed that well as far as the international prices is concerned. So even if you take a period which is going back, this particular period, if you take, it is 2008, over a period of 13 years also. Of course, $15, so now it's 1650, so approximately 700 minus 900, it comes to 800 divided by 100. So for a period of 13 years, it's 88% divided by 13. It will still give 7%. So it would have given you just 7-8% return. So a longer period of time, gold has a problem. It might have given as far as rupee is concerned, mainly because of the dollar rupee factor. But as far as the gold return is concerned, a longer term does not give that much of return. That is why the equity markets are preferred in US. Okay, so it will give you 6.5% to 7% in terms of international level is concerned. At the best, it's giving like that. In a shorter period of time, it gives that 15-16%, which means that it has to settle a little lower in comparison, because 3 years now, if you look at the 5-year period, it is only given 6 points. So a longer period of time, gold probably returns in international terms only 6 to 7% return. That's what we have seen 5 years and 10 years. Now, since in the last 3 years, it has advanced already by 15% or so, next 2 years, probably there has to be some fall in order to ensure that the return comes back to 6.5 to 7%. So on a dollar term basis, on a longer term basis, that probable fall could be a little more forthcoming, but I think it will not. I think there will be a lot of support coming closer to the this is 1522. So I think probably we'll have a lot of support coming at 1550 and 1560. So it may go up a little bit from there. Now let us look at, suppose if you have not made one-time investment, let's look at the SIP return. So in the same case, so since we do not know the general return, let us see whether the SIP return is anything better. Just keep in mind that a 10-year period it has given 6.79 and 5 years 6.89%. So on a 10-year basis, if you have done a SIP, okay, this is 6.79 and this is 6.63. Not much of a difference. For a period of 5 years, this has given 6.89, okay, and there has given 10.03%. 10.03%. And if you have done a 3 years basis, SIP return would have been 11.23. So generally, if you see, in a 2-year period is 6.59%. So probably after some time, 3 year also may drop down to 6.65 or so. There is a little bit of higher levels, mainly because of the this one. So the SIP in a 2-year basis has given 6.59. Yeah, the 2-year basis has given 15.42%. But a longer term, if you look at the 5 years and 10 years, the SIP also is given only 6 and 10. Okay, and this is also given only 5 years again. So probably SIP is still preferred compared to one-time investment, because you still get some higher returns possible. But SIP also over a period of time in gold, in rupee terms itself, has generally been 7 to 8%. This 10 and 11%, probably you do not know whether, because a couple of time back, probably if you got if you looked at it at the peak, maybe all these returns could have been slightly higher. So generally speaking, I think the gold in terms of the, even if you do SIP and other things, probably I think we should be looking at something like 7 to 8%, okay, which is not much compared to our FDs. Which is not much compared. Maybe for tax purposes and other things is okay, but in FDs or short-term debt funds, if you put, you may get 7-8% per annum, a little more stable. So it is up to us to consider whether we should because you should not think too fancy, because every asset should be weighed in terms of what is likely, just because your money has to be used more prudently, right? So you must look at how to rationalize, because less money but more performance, that is what you need, right? So you must be very clever in your strategy. So if you look at this gold in this, but only thing is, I think if you go, because if the gold is idle, then in that case, but if you go for a gold bond investment, you get 2.5% extra. That will be an advantage. So if you go for a gold bond and do an SIP, so generally you may have a 7%, 8% plus the 2.5%. Possibly you will get over a period of time some 10% or so. It's possible. It's completely possible that you get a 2.5% interest on your gold bond schemes. And that 2.5%, if you put it on a SIP scheme, so you add the 2.5% to all these things. So it could be something like 9, this could be something like 9, this could be 13 or 14. So on average, you could be hedging towards 10% if you put in a gold bond scheme. So if you still want to invest as far as gold as a alternative, then in that case, instead of keeping it idle, try to earn the 2.5%. So a gold bond scheme, okay, with a 2.5% annualized and an SIP in that is the best, is a probable scenario to get you closer to 9 to 10% per annum over a period of time. So some years it can be more. This is where probably the return as far as this is concerned. So you then compare with all your short-term debt funds, whether anything can give you 8 to 9%. Okay, so then you compare that. Then you compare yourself with equity ETFs. We have seen equity ETFs, all SIP schemes doing something like 15 to 25%. Right. So maybe if the fall comes, then we do not know about that. Right. So it's something because equity markets generally has less amount of because if you see gold, just look at the performance of gold here again. So this is the say this the equity market. If you look at it, this was the period of 2011. Okay, and 2011 to 2015 it was going down. Right, but it was not say. Let us look at the equity markets 2011 2014. In fact, it was I think I would say it was doing better now. So let us look at S&P 500 or Dow Jones. Let's look at Dow Jones for the okay. So this entire 2011 period, if you look there, if you look at 2011 period to 2015 period, there was a general advance. How much question could be there, but the rally was there. So in this entire period of in SIP scheme, you would have definitely got a higher return as far as Dow Jones is concerned, right? So generally the equity markets, except for crisis period like this, okay, this was a crisis period, and this was a crisis period, Lehman collapse. So this is the systemic problem. So these are the areas which had problem. So this is the area which had a problem. So besides that, you don't see the markets crashing by more than 20% here. So let us say this place, it was 26,950. $21,712. So it was a 5,000 points fall. On a 26,000, it was 20%. That's what I'm saying. So the bigger fall here was only 20%, right? And here also, if you look at it, this fall must have been small. 18,350. 15,370. 3,000 points, approximately something like 12 to 15%. So generally the equity market fall is approximately 10% or so. So generally you keep most of the time you have a fall which is approximately 10 to 15%. Okay. So after that there is always a rally which takes place in equity markets, except the pandemic type of situation. So such situations offers a great advantage to get into the market. Here there's a fall from 30,000 to 18,000. So there was a fall of more than I would say 12,000 points. So 40% fall was there in that. So that's a very unusual scene of getting more than 40% fall. Okay, those things. But anyway, after that, generally the recovery takes place, and within 3-4 years, you always tend to get that levels back. So if you averaged out somewhere doing an SIP or averaged out, you will definitely get a decent return over a period of time. So this is as far as the equity comparison between the gold and the ETF. Okay. Now we have seen other commodity prices also going up, like copper, crude, and others going up. Each one has to be treated on its own merit. So if you look at the copper, I think copper futures, let's say copper futures, we'll put for international price, and this is the monthly scale. Okay. See, for a long period of time, when copper had a from this period of 2011 to I think, except in some bounces, till this year, I think no, for most of the time copper was on the back foot. Except in the period after Lehman collapse, when the world started to recover, then it went up. Okay, for 1 year or 1.5 years, it went up. Say, for example, it was a 2008-2009 period of collapse, and then for 1-2 years, it went up significantly. Now, probably, this is into 1 year of maturity. Now, if you look at it, the number of months, it has taken 1 month or so. So, I think, mostly if you see, even previously, in previous periods also, there was always a vertical rally, and then after some months or so, there is always a fall. Say 1-2, except in 2004-2008 period, which was a period of very big growth globally is concerned. That time the amount of copper appreciation, and after that I think copper also is finding it very difficult to go above those particular levels. If you see the copper, very important high which came here, then this was an important high, and this probably could be a very important high also, because multi-year highs, it has not penetrated beyond this period. So there's a good chance that copper probably also, if it starts falling from this level, then we could see a substantial fall also coming in copper is concerned. So I think that has to be fitted along with our own commodity stocks, and so we need to be quite careful about trading as far as commodity stocks is concerned. The evergreen is still, I told you, as far as stocks is concerned, better to still on the defensive side, better to be with IT stocks. Okay, so this is how the gold performance is. So the conclusion is gold ETFs or gold sovereign gold bonds. Do sovereign gold bonds on SIP basis every month by some amount. Good chance over a period of time you get 9 to 10%. If your objective is say a stable return, decent, and you want to edge or diversify, want to put something in short-term debt fund, 8%. Put something in FD, 6%. Gold over a period of time, 9 to 10%. Equity markets, when it starts doing well, SIP basis can give upward of 15 to 18% or 20%. So it is up to you to decide the mix, okay, to get what sort of return you want, depending on also amount of stable returns also you want, right? So for every month, this one. So keep some funds always to get some stable return, which will meet your daily expenses. So that will monthly expenses, which will come in terms of investment in short-term debt funds or dividend funds, or you can go for fixed deposit. So those funds where probably you can wait to see a big return coming, do it in equity markets. Some amount in order to diversify some periods where probably the gold can do well from some lower levels, to start investing in gold or do an SIP in gold bond scheme. Thank you very much for your participation. Hope to see you with some other interesting lectures in coming week. So now it's a question and answer session for you. Any questions you may ask? Can apply loan gold bonds, generally they give loan, not a problem at all. So any bond scheme, if you want, they will give you loan. But the problem is, if you take a loan, then the question is the interest rate that you pay for the loan and the return that you get in the gold. So that is what you have to look at it. So thanks for your participation. So hope to see you next week. Happy weekend. Thank you very much. Bye.